Okay, it is 7 p.m. over in London. Jimmy Young here with session number 4 of 6. Today's topic is going to be fundamentals. And to keep the torture to an absolute minimum, we're going to have a shorter session. It's not going to last an hour and 15 minutes. Probably going to be closer to a half an hour or 45 minutes. We got to see how we go. But we don't want to overdo it with these fundamentals. They have a bad reputation as it is. So I'll keep this as short as I can. I think there are certain things it would be important for you to be aware of. Again, this is geared towards a new trader, somebody who has no experience trading or no experience with Forex. And it's talking about the real basics of Forex fundamentals only. That's the only topic here. The topic here is not to give you a system to go home and trade and get rich from Forex. It's simply to give you an overview to whet your whistle of interest in learning about the Forex market. Hello from Germany, Dimitri. Hello, David. Well, good to see. We got lots of people here, and we're getting lots of people at the last minute here, which is just fine. People are interrupting their dinner to join us, so that seems good with me. I'm going to go ahead and share my desktop with you. Monitor 1. And there we go. So as you can see, we are right on time. Some of you who do get the Trade Finder see this every night when I put this up and say, okay, it's 7 o'clock over in London and it's 2 o'clock here on the East Coast. Okay. So here's a little PowerPoint I made up for today. I made this one up from scratch. I make it a point to produce new documents pretty much for everything I do. It's just my own personal style. I know some people use the same documents for 10 or 15 years. I just feel the market is changing so rapidly with the new communications and the new speed at which things happen that anyone using an beat up old analysis of anything and calls it correct is probably wrong, because the markets are changing so quickly that unless you're hip to what's going on in the modern world, unless you have an idea in Forex, for example, what truly drives the market, what truly looks like it's causing the moves, or at least what helps us to see the moves. The end game is we're just looking for something to help us with our decision-making process. And that's what fundamental analysis does for you. Anything that helps you to make a better Forex trade that is not found on a chart or is not an interpretation of a price chart would be a fundamental. Fundamentals can occur before the trade, where you can look at certain things before the trade, certainly during your trade. So before the trade, so that you can avoid getting into bad trades to begin with, or perhaps have that little extra bit of confidence we all need to get into a trade. You know, I know the fundamentals. I was just reading something this morning. I happened to just do a random search on Google of fundamentals, and there was a big, long article on how if the fundamentals are not necessary, that everything's in the price chart, that there's no reason doing all that work. And as I've told you in the first 3 webinars, there's a thin line between trying to simplify something down to the point where there's nothing to it, it's so easy, and then thinking about the fact that you're betting your money, real money, on your trades. Now, I was thinking about this further sitting here before the seminar and thinking, well, what about if somebody bets 20p or even one quid, £1 per point? So if he doesn't trade and he makes or loses 30, 40, 50, 60 pounds, it's not the end of the world. But look at it this way. If you're serious about making a living from Forex, or making decent money from Forex, or have a dream that someday you could make enough money from Forex that you could sit home and not have to go into some terrible job that you absolutely hate, with people you absolutely hate every day and commute back and forth. If you're thinking in that direction, well, then you're going to be thinking about putting on bets for more like 10 or even 20 pounds for each point, which means risking 300 to 700 to even 1,000 pounds on a single trade on a single day. Well, wouldn't it be nice to have a pretty good idea of what's going on when you're putting such large amounts of money on the line? You see, this is where the argument, I want this to be really easy, seems to break down in my mind, because I think for most people to get to the point where they could actually make bets that are big enough that they could actually make a significant amount of money from Forex. And I put that in the 5, 10, 20 pounds per point area. To get to that level where you're confident to bet that kind of money, you really do need the confidence of knowing that you know what you're doing, knowing that you have in front of you a news screen, and when things come out on that news screen that are colored a certain way or flashing or jumping up and down or whatever your particular news service is doing, that you're confident that you could read it, understand it, and actually not only not benefit from it or not lose from it, but actually make money from it. Actually have the ability to look at the news and say, you know what, that's going to cause a particular move in a particular currency pair, and I should get in on this because chances are that this is going to cause a particular currency to move or currency pair to move in a very particular way. And it's with this confidence, that when you have a trade on, that all of a sudden there's not going to be a news item that you didn't know anything about that's going to blow your trade up, and 1,000 pounds or 500 pounds along with it. It's this confidence of knowing that these surprises are going to be, if not eliminated, but actually reduced to a minimum, and potentially the news become a source of making money from you as opposed to a source of constant worry. In other words, something to dry up the palms of your hands when you're trading. If you look at it from that point of view, then the very small amount of effort it takes to learn about the fundamentals becomes clearly worth it. I was talking to my son this morning, and he said, "Dad, how do I know? I understand when a news item, for example, is a number. I do understand that if the number's much better or much worse, it's going to cause the currency to move right away. That's pretty clear to me. But how do I know when it's words, when a statement comes out?" Because as most of you know, my son just started trading a week ago Monday, and he said, "So how do I know? How do I know if it's good news or bad news or what kind of news?" And I asked him. I said, "Well, you're a champion player at the game of Call of Duty, which is one of those shoot 'em up games." He says, "Yeah." I said, "Well, I've never played the game." I said, "If I went into that game and I saw who my competitors were, would I know whether or not I was going to have a tough game or an easy game or where I stood?" He says, "No, you wouldn't." I said, "Well, what about you?" He would say, "Well, I know exactly where I stand because I know all those players, and I know how they play, and I know how to play them." I said, "Well, that's where you need to get in Forex. You need to get to the point that you know all the players. You know who the key guys, the one or two key guys in about 5 or 6 different countries, so a total of 8 or 10 guys worldwide." I asked him, I said, "Well, how many players do you know in Call of Duty?" He says, "I probably know 250. I said, "Well, I'm asking you to learn about 10. And then based upon what they say, after a while, it'll become very clear to you what you should do in the Forex market. And if you wanted to, that's all you would have to do is sit there and wait for these guys to say something, know what to do, and make money just from that alone." And he said, "That's kind of interesting." But being a 22-year-old, he wasn't too impressed. But that's pretty much with what fundamental analysis comes down to. It comes down to, okay, you learn a few things, but the way you can learn to apply it is by actually seeing it in action, which means you'll have to take the next step, which is to actually read the news a little bit. And you don't have to do it necessarily at the beginning. You don't have to do it in real time. You can look at your chart at the end of the day, or as you're sitting there trading it, all of a sudden, when you see a bar on your 5-minute chart that's 8 times bigger than any other bar, well, I can almost guarantee you that wasn't caused by price action. That was caused by a news event. So you could go and see what that news event was and think about who said it or what was said and how the market moved and in what direction. And over time, days, weeks, you start to build a mental library, or you could even write it out. We have one student, his name is David C. I won't mention the last name. And the other day I was on Twitter, and I looked and I said, there was a trade my son had done. So you guys who get Trade Finder remember this. And the trade was just a bad trade to take. It was a trade signal, but from 3 different directions it was saying, don't take this trade. And my son took it because he just doesn't know what he's doing yet. And the trade lost. And that night when I made the Trade Finder out, I actually was talking to my son and I explained the 3 reasons why he shouldn't have took the trade. And as I was getting ready to send out my Trade Finder, I noticed that I went on Twitter and one of my students had the exact 3 reasons in real time. Now I'm talking about this trade signal occurred at 9:15 in the morning your time. And at 9:15 in the morning your time, this trader said, don't take that trade, and here's the reasons why. 1, 2, 3. And it turned out to be the exact same reasons I had told my son. So I put on the Twitter, I said, that's really good trading. That's really good that you knew all that. And I left it at that, no big deal. Lo and behold, the next morning, I look in my email box, I got an email from him. And he said, I do this kind of analysis for all my trades, and my trading has gone from being a loser to being a very pretty big-sized winner. Would you like to see my trades? I said, sure. So he sends me an Excel document, and in this Excel document is every trade he's ever done since he started trading, where he got in, where he got out, what his P&L was, why he got into the trade, what changed during the trade, and ultimately why he exited the trade. See, that level of dedication to what he's doing over a period of months, it was actually about 3 months he sent me, he really gets it to the point he's able to identify a bad trade 100 miles away. And it would be the exact same thing when he gets to it, when he gets to the fundamental analysis. He'll start to understand how to break it down and how to find the good and how to avoid the bad. And it's not really much different than the technical analysis. In my opinion, and this is my humble opinion, it's much easier, in my opinion, it's much easier to say that a particular currency will go down because it just had bad news than it is to look at some kind of magical indicator or chart formation and say it'll go down because of that chart formation. Because the reasons that it gets to that point may not agree with that move continuing. And that's one of the biggest problems I have with technical analysis in general, is that we forget the fact that it also is very subjective, and it also a lot of times requires judgment. It's not clear exactly what to do all the time. It's very easy in hindsight to look at a chart backwards and say, yeah, I would have done that and I would have done that. But when it comes to doing it in real time, as many of us find out, it's a hell of a lot harder than those magic indicators with those isolated examples you see on these different places make it appear. So once again, the fundamental analysis, before you even put a trade on, it can tell you that the price got here for the wrong reasons and this move will not continue. Or it may tell you the price got here for all the right reasons, and based upon the trade you're doing, it's a great time to be going the other way. or it could tell you during the trade that there are signs that this trade is going to fail, even though the price hasn't figured it out yet. Or it can allow you to put a trade on a lot sooner than technical analysis, because with technical analysis, it has to achieve a certain level. You know, another big problem for me with technical analysis is the price of 55 is a good buy, and the price of 54 is a screaming sell. And the difference between a 54 and a 55, it could be, if you look at it in terms of a whole day's movement, is maybe 1/4 of 1% movement. It's such a tiny movement, and you know the one being the difference, totally a difference of one being a buy, one being a sell. It doesn't even make logical sense that anything so minuscule should really make all that difference. So I think that technical analysis needs a lot of help in order to make a successful trader. And that's why I try to get my traders to at least do a minimal amount of work with the fundamental analysis. Now, there's only two things right now that you really need to know about fundamental analysis to trade this market pretty well. Just two little things. That's why I said this session may not even last an hour and 15 minutes, because there isn't that much to it really. But this is the problem in a nutshell for most of you, is that just the technical part alone, you got your hand on your head and you're saying, oh my God, there's so much information. I just don't know what to look at. I don't want to have to learn all this. What you want to realize is, whether you want to trade Forex for 5 minutes a day and try to make £5 a day, or whether you want to trade Forex 24/7 and make £50,000 a week, it doesn't matter. In terms of getting the trade right, it's just a matter of the size of the trade. So whether you're trying to make almost nothing, or you're trying to make tons, or whether you want to spend a lot of time or a little time, you still got to know what you're doing if you're going to be able to make money. And you know, this is the thing you have to understand, is that if you think of trading the same as being a doctor or a lawyer, you know, would you go into court, you or me, who don't know a damn thing about being a lawyer, would you be comfortable going into and defending a murder case because you did a couple of webinars on law on the internet, or you read a couple of books on law, or you listened to a couple of YouTube videos on law? Do you think you'd feel confident going in and defending a murderer? Of course you wouldn't. And it would be the same if you wanted to be a doctor. You know, I was at a seminar and a doctor said to me, you know, I said, what do you do for a living? He said, I'm a doctor. I said, okay, doc, you know, well, I wanted to talk to you because I just want to, you know, I don't want to have to learn. I don't have to go to medical school. I don't want to have to do a residency at a hospital. I don't want to have to learn all the mathematics and physics and all. I just want to have something where I can do one operation a month and pick up about $5 grand. So I just want you to give me a couple of, you know, for a few hours, just give me something I can learn that I can just do one operation a month. And he kind of laughed and got the idea, because this is kind of what he was asking me at the seminar. You know, can you just tell me one simple thing? You know, I'm a doctor. I don't want to spend any time doing any work in Forex. I just want one simple little thing to make a lot of money. And I don't want to have to sit there and watch the market. Basically, I don't have to do anything. I just want the money. And I said, well, okay, well, do that for me in your profession. You know, give me something I can do in your profession where I spend 2 hours. Because in a way, you know, my profession, being a professional trader, a retired one, but still a professional trader for 20 years of my life, where I sat there and traded at the professional level for 10 or 12 hours a day. You know, it is a profession, and it is a skill, and it is a very difficult skill to master. It's not like it's so simple that there's nothing to it. All you need is some kind of magic indicator, and that's all you need. You know, so we should all respect the fact that if you want to be a trader, you're going to have to do some work to get there. If that's not your goal, if your goal is, well, I just want to do a couple of these free webinars and then do it on my own, that's the same thing as saying I want to be a lawyer or a doctor. I don't want to go to law school. I don't want to go to medical school. I don't want to do anything. I'm just going to, start prosecuting cases and doing operations, and I'll see how it works out for me. Well, you know how it's going to work out. You're going to crash and burn. And that's the net result of most retail Forex traders who do that kind of an approach. So although it's difficult and there's a lot of information, you do need a very solid nucleus of information from both a fundamental and technical point of view. And as I was explaining to my son this morning, the most important thing is that you're using the right information. And the right information, I didn't know what the right information was 5 years ago. Why would I not? Because the information that the market's using to base their decisions on changes with our modern internet-driven, speed-driven computers. What's causing markets to move today is totally different than what caused them to move years ago. And unless you can understand that, unless you're willing to accept the fact, and we don't want to, let's face it, I'm 57 years old, there's a bunch of people in here probably in their 60s, and there's a bunch of know-it-all 20s in this audience, and nobody wants to give any ground. Everybody wants to do it their way and believe what they want to believe, but what you should believe, is somebody like myself who's been doing it more or less my whole life, someone who does this every single day for a long time, that this requires a certain amount of effort, and there's a certain amount of judgment involved, and good judgment in trading comes from sitting there trading it. It doesn't come from a book, and it doesn't come from a magic indicator. It comes from sitting there and understanding the symptoms and making that judgment, very similar to what a fireman does, or a policeman. If a policeman goes into a burning building and they drop him on top of a burning building and tell him, go find the people who are alive in there, there's a way of doing it according to the book, and then there's the way a fireman would do it based upon his experiences as a fireman. And if he chose to use the book method, he probably would get himself killed. It's just the fact that they have so much street smarts is what it is, that they're able to adjust to the situation and make the judgment call right on the spot. Well, believe it or not, that's what trading is all about. It's taking it to that next level. It's not about learning the systems and learning the methods and learning this is where you tell me where I should get in, tell me where I should get out. Basically, tell me everything I should do. Well, then I'm a little confused where the trader comes in. How can you call yourself a trader if you don't do anything related to trading? What you are is some kind of glorified order clerk, and you don't deserve a hell of a lot of money for being a glorified order clerk, nor will you get it from the market. It's only the traders who know the technicals, know the fundamentals, and put in a huge effort that are taking the money out of this market. Not the people with the magic indicators or the expert advisors or whatever else they're coming up with these days. For the most part, these are not the people making the money. Now, we could simplify this down to just trading the euro-dollar pair, which I think is a fine place for a new trader to start. Believe it or not, just trading something as simple as the euro-dollar pair is a hell of a lot more complicated than you may think. Now, what you may think is you've got the dollar, you've got the euro, and you've got the chart. So all you got to do is look at this chart. But what you're forgetting is that what causes this chart, what causes this kind of stuff, empty spaces on charts, etc., quick moves on charts, is generally related to something going on in the euro or something going on in the US dollar. All this chart is telling us is on a continual basis who's winning at the next moment. Is it the euro or is it the dollar? And in a given day, The euro is going to be winning for a while. The dollar is going to be winning for a while. Then the euro will be winning again. Then the dollar will make a comeback, but not quite as far. Then the euro will get a little weaker. Then the dollar will get a little stronger. And it's the net movement of the both of these all day long, which creates this little chart. But this little chart is primarily driven by the news that's occurring in the euro and what's happening or how the dollar is being driven. These two things are really determining this chart. So to leave out the part of what's going on with the euro and what's causing the dollar to be driven, to leave out those two key factors and just base it strictly on the chart because that's easier. You know, I think the expression I was reading on the internet this morning when I was reading about fundamentals and how you don't need them is a nice clean price chart. All you need is a nice clean price chart. Yeah, but that nice clean price chart is not telling you dick. It's not telling you anything. But that alone, in my opinion, can be almost useless unless you can relate it to certain things and find some value. That's what traders do. They find value. You know, the euro-dollar pair came down to this price level for this reason, and given where we are in the day, and given what that reason is, and given the symptoms I'm seeing in both of these currencies individually from their key things we can look at, this could be not a bad place to try for a move in the other direction. This is what a real trader does. You know, kind of what we'll call it a fake trader does. It's just look at a chart and look back, 3 days ago it stopped at this price. This must be a good level to buy. You know, that's going to work. It's going to work approximately half the time, which flipping a coin would also. But approximately half the time will keep you entertained. It may even stop you from losing all your money right away. But over time, unless you have good methods, you will lose your money. It's garbage in, garbage out. Go-go is what it's called. So let's look at if we're going to just trade the euro-dollar pair. I just want to show you, if you're just going to trade the euro-dollar pair, you can't leave out two key fundamental things right now. You know, I'm not here to give you an economics dissertation of all the cookie cutter stuff. Another thing when I noticed when I went to the internet is that nobody distinguished between the things that are important now from a fundamental basis and the things that were important 5 years ago. You know, a lot of the things that are put on the same pedestal as being important, it's almost a joke that the people writing this stuff are so clueless of what they're talking about. And we're going to get to that. I'm going to get to that later. I don't want to jump ahead. Let me start with what drives the U.S. dollar? Is there something we can look at on a daily basis that we could say causes the U.S. dollar to move up and down? Now, the U.S. dollar is not a currency pair. The euro dollar is a currency pair. Aussie dollar is a currency pair. Your beloved pound dollar is a currency pair. New Zealand dollar is a currency pair. Dollar Swiss is a currency pair. Dollar yen is a currency pair. Dollar Canada is a currency pair. And what it is simply how one currency is moving in terms of another, or the value of one currency quoted in another currencies, in another foreign currency. That's all a currency pair is. But by itself, there's no such thing as trading the dollar. If you want to trade the dollar, you also got to trade somebody else because they always trade as pairs. And if you're trading the dollar, as part of that pair, you're also trading the euro. So you could be dead right about the dollar, and the euro could totally screw your trade up. Remember, it's just a one-on-one race. So if you totally think the dollar is going to run very fast, the dollar could run very fast. But if the euro is running faster, you're losing on your trade. That's the beauty of it. It's just a one-on-one fight, if you will, that determines the direction of the exchange rate. Whoever's winning is causing the exchange rate to move in that direction. So you want to realize that there's no such thing as just trading the dollar or trading the euro. You have to trade them both when you're trading a currency pair, because either one can impact the price of that currency pair. But there are things we can look at very specifically related to the euro and related to the U.S. dollar. So with the U.S. dollar, what impacts it the most, just like any other country, is going to be its employment situation, its retail sales situation, how its whole economy looks as one number, its GDP. What kind of yield or interest rates a currency is paying is always important. And what the government is saying about that currency. These are the key things that are going to influence the dollar, influence the euro, influence the Aussie, the New Zealand. But we're not going to go in that direction because we said we're just focusing here on the euro and the dollar. So the underlying fundamentals of both the euro and the dollar are going to impact the value of the euro-dollar pair. Now here's where it gets really interesting, and here's where it gets really simple. The stock markets are going to reflect everything going on in the dollar and everything going on in the euro. And what's important to realize is the stock markets tend to move very similarly. So let me put this very easy for you. If bad news comes out about the euro, then the U.S. stock market and the German stock market, the DAX, are going to go down, both of them. And if good news comes out for the U.S. dollar, then the U.S. stock market's going to go up, and so is the DAX, the German stock market, going to go up. Now, a couple of you are probably sitting there. There's a couple of you guys who have to know everything about everything, but never gotten to the point of doing a real trade yet because you're trying to know everything about everything. You've kind of taken it to the other extreme. You become students and not traders. There are tons and tons of different stock markets out there, okay? The ones we focus on for our trading, for people who really want to trade and don't want to waste a lot of time on analysis paralysis, we focus on the DAX and the Dow because we can see some very, very clear relationships going on. Now, one of them is, if you look at what the DAX has done for the last 6+ years, and you look what the Dow has done for the last 6+ years, you see that their charts look virtually identical. And if you look what I just arbitrarily, and as some of you know that on that Dania, it defaults to 300 periods. So I arbitrarily took the 1-hour chart. I did this on the weekend, this past weekend. I took it for the last 300 periods until Friday's close. And this is looking at what the DAX has done, and this is looking at what the Dow has done. And as you can see, they're almost identical here, and that's only for the last 6 weeks, as they are here for the last 6 years. So what you want to understand is that the stock market has gone global. The stock markets in general, they move as one big blob. And there's a concept behind it which relates directly to the trading that is there every day. Does it work perfectly every single day, every minute of every day? No. But it's something that's there, something you can use in your trading. But once again, for you guys out there who want to reduce everything down to, I only want to have to do one thing. I don't want to have to think. I don't want to have to watch the market. I don't want to do anything. I just want the money. This is not really going to help you because it actually is just part of the process of being a real trader. It's not one of those, you did not find the little leprechaun and the pot of gold here. What you found is someone willing to tell you something that most other people don't about the market. Now, I think just alone to see that the DAX, the German stock market, and the U.S. stock market move almost identically over the last 6 years and over the last 6 weeks even that could be inspiring to some of us, but some of us are very impatient. We're sitting there thinking, okay, well, what's the magic formula? Come on, you're beating around the bush. Tell me, how am I going to make all this money? I need to know now. Unfortunately, it don't work that way. What this is one very clear tool you can use that can help you in the process of being successful at the most difficult game in the world, trading. So try to be patient here, try to learn from this, but realize that none of this is an introductory level to get you thinking along the right lines. This is not a tell me everything to do about Forex that I'll ever need to know. It's not meant to be that. It's meant to get you interested enough to take this at least to the next level or even the level after that to get serious about first getting a good education and then get some good coaching and eventually do some trading on your own. Let's take this the next step. Now, why do we care? Well, the stock markets these days, if you read up on them, you're going to hear the term risk, R-I-S-K, risk, used more than anything else. Risk on, risk off. Risk on, risk off. You're going to hear these terms constantly if you follow the stock market. Now, risk on describes the stock market going up. Risk off describes the stock market going down. Now, why do we care about the stock market going up and down? And when I say the stock market, I mean the DAX and the Dow. I mean these two specifically. And I'm sure somebody right now is typing in, what about the FTSE? What about the Shanghai? What about the Japanese market? I don't care about any of those markets. I don't follow any of these markets. What I'm interested in is helping people to trade during the London session and the US session. Hence, the DAX is open for almost the entire London session, and the Dow is open in the New York afternoon. And we have the Dow futures open 24 hours a day. So there's always a way of seeing whether stocks are going up or down. Now, here's why we care. When the stock indexes, when the Dow Jones Industrial Average, when the DAX is going up, the US dollar is going down. This pattern has been around for a number of years. Not every minute of every day. It's not like if the Dow goes up 3 points, the dollar goes down 1 point against euro. There's no magic formula here. What there is a pattern. We can look at a chart. We can look at a 6-year chart of this, and you'll see that the pattern is very clear and it's very pronounced. And most of the time, the pattern holds up. If we were to put up the last 6 hours of today, we would see that, yes, the pattern holds up. And 4 out of 5 days a week, the pattern holds up. 1 day a week, it doesn't. So there's no magic here. What this is another clue. Now, I personally think that a lot of currency trading is done directly off of what the stock market's doing. And there are methods to trade it, but it's not as if I have some kind of, okay, tell me step one, okay, then where do I put my stop? Where do I put my profit under all conditions, no matter what happens after I do the trade? Unfortunately, I ain't that smart, and I don't think anything like that really exists. That only exists in the minds of marketers trying to sell it to you to make it sound like it does. But in reality, every bit of a trade, from the beginning to the end of the trade, is torture. It's hard work. You put a trade on, it's working, you're afraid you're going to lose your profits. That don't feel too good. You put a trade on, it's losing money. That don't feel too good. So there is no feeling good in trading. Trading is about making money. It's not about having a good time. If you want to have a good time and make money, well, get somebody else to promise you they can accomplish that for you, because that's just unrealistic. And for someone who's done it his whole life full time, I can tell you it's never fun. It's always hard work, and it's always annoying because you're always worried because the prices just don't go in one direction for the whole time. They always come back and back and forth and back and forth, and test your patience. And you could do the exact same thing, the exact same you could take the exact same signal under the exact same conditions 2 days in a row. One trade will work perfectly and the other won't work at all. And you'll say to yourself, damn, I did that yesterday, it worked perfectly. I did it today, it didn't work at all. How can that be? That's because markets are not like ecosystems. Markets are not, in an ecosystem, you study ants and how they behave inside a little anthill. And they go and some of them go and get the food, and other ones protect the certain areas. Everybody has a function, and it's always consistent that they behave the same way every day, in, day out. There's a method to it. There's a certain pecking order to it, and we're taught like this since we're little kids. Right from wrong. We're told when we're given rules, and so all of us try to live by rules. And when you get into the trading arena, what you got to do is you got to forget all about the rules, and you got to start thinking more like an artist. You got to be thinking more like just general guidelines. With the exception of having a daily stop loss limit. Most of trading has to do with having guidelines for yourself and not rules, because all rules do is it takes away all your creativity and all your ability as a human to think and replace it with some kind of an ironclad rule. And that's why most traders are unsuccessful, because they're always trying to put square pegs into round holes. They're trying to put yesterday's rules into today's situation, even knowing that today's situation is a little different, and perhaps it ain't the best thing to be doing. We got to get to the point where we can get beyond that. All right, so just to continue on here, so if the stocks are going up, the dollar is going to be going down almost all the time, but not all the time. And when stocks are going down, the dollar is going to be going up, but not all the time. Now, I know some of you, at least 2 of you in this room right now, are saying, this is totally useless for me. If I don't know where stocks are going, if I knew where stocks are going, I would just trade stocks. We got our two skeptics in the room, like every room. Skeptics are good at two things, okay? Skeptics are good at staying out of bad situations. They're also really good at never getting in a good situation because they doubt everything. You need to be a little bit more open-minded if you want to be a trader, and realize that nobody's going to hand you everything on a silver platter. You're going to have to make that effort, and you're going to have to come up with unique methods, ideas, and good discipline, and do so much more. That's what's going to make you successful, not some kind of magic formula. So the fact that the stocks, well, let's take a look at this. This is the equation, right? Stocks up, dollar down, stocks down, dollar up. And the terms you'll hear in the market, risk on and risk off. So when the market's afraid things are going bad, everybody runs into the safety of the U.S. I'm sorry, when things are bad, everybody runs into the safety of the U.S. dollar. When things are good, everybody's running into more risky investments that are going to make more of a return. That's, in theory, what the risk on, risk off equation is all about. Why do I keep on it so much? Because in my opinion, you could just trade the currency market off of the stock market alone, and you'd have much better results than any magic indicator could possibly conceive. Now here's what it looks like. If we're looking at it, I'm looking at the same exact chart. Here's the DAX and the Dow for the last 6 years. So we just looked at these two charts. In brown, I overlaid the Aussie dollar pair on the chart. So this is the Aussie dollar pair for the last 6 years, going up and down with the stock market, whether it's the Dow or the DAX. And for the last 6 weeks, we looked at these exact same charts. I just added the Aussie. And you can see when the stock market's closed here, this part of the day. At this time, this is a 1 hour chart. These are the hours the stock market is open. And you can see the Aussie dollar pair pretty closely followed exactly what the stock market was doing during those hours. And it also followed the DAX, it also followed the Dow very similarly throughout the day. And so there is something going on here. Now, again, for you skeptics in the room, well, Jimmy, is there a 20-minute delay, a 5-minute delay? Does the Dow lead the Aussie dollar, or does the Aussie dollar lead the Dow? Stop and think a minute. Do you really think that stock traders see what the Aussie dollar pair is doing and base their stock picks on that? I don't think so. But there is something going on the other way around, where traders, big traders, are watching what's going on in the currency markets. What's going on in the stock markets and trading the currency markets with programs, with trading programs. And I think this does go on. And I think it's not an ironclad rule that they do it every minute of every day. But if you look at this, what I'm showing you here for the last 6 weeks, how this follows. It's pretty good. It's pretty close. All right, let's move on a little bit. Now, when stocks are very quiet, when stocks aren't doing anything, well, then the U.S. dollar is on vacation. Yeah, as you can see, it's got its towel and its beach chair. It's at the beach. The dollar's on vacation, so the dollar is not being driven. See, the dollar really doesn't get driven by much. And when we talk about how it's driven by its own economic fundamentals, such as its payrolls and retail sales and how the economy's doing and what's happening with what the government's saying, it tends to be, in many cases, just the opposite of what you would think because of the relationships between stocks and currencies, and stocks and the dollar in particular. So based on what you just learned, whether you know it or not, when the stocks go up, the dollar goes down. So if we get really good news, like a good payroll number for the U.S., believe it or not, stocks go up and the U.S. dollar goes down. So the dollar actually goes down on good news. And I think this is the reason that so few educators even try to teach fundamentals. They'd rather say, wouldn't you rather work with a nice, clean price chart? And frankly, if I was 65 years old and somebody said, do you want to work with a nice, clean price chart, or do you want to have to learn fundamentals? I think I would choose a nice, clean price chart. But what they're leaving out of the equation is probably the difference between being successful and unsuccessful. You know, if you leave out of the equation what causes the moves entirely, leave that part out and assume everything is in the price. See, what you want to remember is everything is not in the price. When the news hits, everything will be in the price. So being aware that the price is going to go from point A to point B, in a lot of cases you can get on that train and ride that train and make very significant money. The technical analyst leaves that out and they say everything's reflected in the price. Well, that's not true, because every time a news event happens, there becomes a huge price change. If everything was in the price already, that wouldn't be the case. I think what they should say is, well, everything will be in the price, which means all the technicals you're looking at the moment, you might as well throw them out the window for the next 10 minutes because it's going to look totally different in 10 minutes. And then we can go back and say everything's in the price, so now we can play with our technical indicators again. And I do mean play, because in the absence of using the fundamentals as part of the game, I think that's what most people are doing. They're playing, with the exception of some of the best trading funds in the world, such as Renaissance Capital, etc., who have great technical programs that actually can make money just looking at technicals. But even them, I'm not sure what's built into their models because they don't tell anybody. So they could be building in things that are of a fundamental nature as well. I'm sure they're very sophisticated because they make money all the time, and I'm sure they're not sitting around saying, how can we make this nice and simple? I don't want to have to do anything. How can I make this as simple as possible? I don't think that's how they've managed to have a 20-year record of 20% a year for the last 20 years. I don't think that's the way that happens. Now, we talked about the dollar as part of the euro-dollar pair, And we said that in order to trade the euro-dollar pair properly, then you should be aware of what the US dollar is doing. And one thing for sure, if stocks are moving, the US dollar is probably moving. And if stocks are going up, the dollar is probably going down. And if stocks are going down, the dollar is probably going up. And again, what we need to remember is we're not talking about every 2 or 3 point movement in the stocks. We're talking about when there's a significant movement. What does significant mean? When you get, to use a number to give you some exact yardstick to feel this, let's say the average move lately in the DAX has been 150 points a day. Well, if it moves 50 points in one direction in an hour or two, that's a good move underway, and you can bet that the dollar is doing just the opposite of what that move is doing in the DAX almost all the time. So it is a major factor in trading something as simple as the euro-dollar pair, because you probably all heard how easy, just trade the euro-dollar pair, you don't have to know anything. Well, yes and no, because there are some things going on, like if you kept your eye on the stock market, you'd have a much better idea of where that euro-dollar pair is going. And secondly would be the situation with the euro itself. Now, as far as background goes, late in 2009, the government or public debt of Greece spiraled out of control, and the euro, as a result, because Greece is a member of the euro countries that make up the euro went down, suffered on that. And after that, we had similar problems with government debts in Ireland, Italy, and Portugal, to name a few. So in May of 2010, in their usual lightning speed, the governments, the finance ministers of some of the European countries, they come up with 750 billion euros for a rescue package to create what's called the European Financial Stability Facility. Now, European Financial Stability Facility, say that 3 times fast without stopping, Sally She wears seashells by the seashore kind of a deal. It's not even easy to say, but the EFSF is what it's called. I can tell you this, every time the word EFSF appears on your trading screen, if you're watching the news, you probably know where the next 30 points in euro is going to be. So, in the euro-dollar pair is going to be, because there's probably some news about the euro. And right now, this is extremely important. Now, why right now? Because in October, things got so bad that the same European finance ministers gave up, and they took it to the next level, which is to look at the real big guys, even above the finance ministers in each of these countries. And they agreed on a package, basically to prevent Greece and some other countries from basically falling apart totally, because their debts get totally out of control. Now, you're probably sitting there saying, nope, Jimmy, much too complicated for me. Nope, I can't do this. I'm too old. I'm too young. I'm too smart. I'm too stupid. I'm too something that I can't read these 3 sentences and understand what you're talking about. And I certainly couldn't look at a news feed and be able to decipher a headline. No, you couldn't do that right this minute. But if you read these headlines every day for a month or 2, and you got in tune with what was, and you watched, you said, oh, I see that headline, I see the euro did this, I see this headline, the euro did that. Well, after doing it a while, you could do it. You can't do it today because you don't know anything about it. Just like I couldn't go in and I couldn't fill a cavity in somebody's tooth because I didn't study to be a dentist. I don't know how to do that. Well, you don't know how to trade the euro based on news because you've never done it. It's not that you can't do it. We got guys in this room who are engineers, doctors. They were able to pass all those tests for biology, all that stuff, get through medical school. I wouldn't be surprised if we had a lawyer in this room. I know we have people who started their own businesses from scratch and made successful businesses. So when you tell me you can't read the news and understand it, I say bullshit. I say you don't want to be bothered to do it. Not that you can't do it. There's two different things. Now, this is the situation going on right now. Right now, if the German government wants to borrow money, they pay less than 2%. If the U.S. government wants to borrow money, they pay 2%. If the UK government wants to borrow money, 2%. Sweden wants to borrow money, 2%. Switzerland, 1%. Japan, 1%. Finland, 2%. Denmark, 2%. 2%. 2%. Now, then you have Greece, 31.7%. Now, to understand what's going on, you just need to think about this in terms of yourself. If you had to pay a 32% interest per annum on your mortgage on your house, and you had to pay 32% on your credit cards, and you had to pay 32% on anything, a car payment, whatever it is, and you were making a 10 or a 20-year projection, you too would be bankrupt. Unless you had an awful, awful lot of money. There's no question you too would be bankrupt. So why is Greece interest rates 32%? It's a matter of confidence. The market feels that they're not going to be able to pay back their debts. So if you want to borrow money when nobody thinks you're going to pay back, you have to pay a very high interest rate. Now look what's happening with Portugal. They're up to 12%. Spain is up to 6%. Ireland's at 8%. Italy's on their way to 7%. All of these members of the euro, like 5 or 6 of them, are paying interest rates from 3 to 15 times higher than they should be paying. And this is what this crisis is all about. And it's just a matter of confidence. So each time it looks like on the news they're coming up with a solution to get this problem resolved, the euro goes up. And each time it looks like the problem's not going to be resolved, then the euro goes down. Now you add to that a little bit of crowd psychology, and they probably go up a little more or down a little more than they should. But all of those countries there are all members of the euro. And you can see some of them still have normal interest rates, and some of them are considered problem childs, but it's a contagion. It started with just Greece, and now you got Portugal, and you got Ireland, and now Italy and Spain, and pretty soon they'll be finding other ones. You see Belgium starting to break out, unless they can fix this problem. And as far as trading goes, we don't need to know much more than if we look at a headline and it looks like the first time you look at it, you don't know. The second time, I think that's bad news, and you see the euro start to go down. And maybe by the third, fourth, fifth, or 10th time you see it, because this ain't going away. This problem's going to be with us for a long time. And when it's not this, it's going to be something else. It's going to be some other F word, some other fundamental. It's going to be the market driver or the market sentiment that's causing a lot of the exchange rate movement. This is the easiest way to make money from Forex, not the hardest. And it's not even that difficult. It's unfortunate that most educators have no clue. They've never really traded. They really don't know anything about fundamentals, or they don't really understand how to trade and make money, because they make their money from teaching other people to trade as opposed to actually doing it. When you actually do it, you have a totally different perspective of how to do it than if you're just trying to say something that sounds good. Because let's face it, there's 14 flaws between doing it for real and talking about it. What's supposed to work in theory and what works in reality are two completely different things. And what everybody wants to hear is a nice, easy way to do it, you know. So, all right, let's move on a little bit. So I'm going to just give you a quick couple of words on each of the countries. I said we were just going to talk about Australia, euro and the dollar, but that would be it for the euro-dollar pair. You would have how the dollar moves inversely to stock markets and how the euro is being driven by what the EFSF, is up to, what the rating agencies such as Standard & Poor's, Fitch are saying about these countries, whether they're saying they're in worse shape or bad. And every time you see the interest rates in any of these countries going up, that's a bad thing, because it means that they're becoming less and less credit worthy. The same as if you had to pay higher and higher interest rates. First of all, it's bad for you from a money point of view, your own personal money, but it's also your reputation's getting worse and worse, because that's why they're going to charge you more and more interest. And sadly enough, it can be a case of the interest rates causing you the problem, because it becomes impossible for you to just make all these payments. So it is a real serious problem we have going on in Europe, and it is a huge part of the market. You know, unfortunately, it's not as simple as, well, I think I'll just sell the euro and come back in 6 months and see how I'm doing. That's like saying, I'm going to be a lawyer. I think I'll go to court on the first day, and I'll do my opening argument, and I'll come back for the close and see if I won. It just don't work that way. Even a lawyer can have a case, a certain exact way he plans on prosecuting a case. That's similar to having a trading system. And then as the case develops, then some things happen. If you ever watch TV, there's always some kind of they throw a little clunker in there and everything's different. And now the lawyer has to completely change his case. Well, guess what? That's what traders do. They change along with the market. They don't sit there with one idea and say, I'm too much of a nervo to change my mind, so therefore, even though things have changed, I'm still going to trade the same old idea with the same stop and the same take profit. It's this level of stupidity accounts for a lot of the losses from the retail trader. But we're going to get into that next week when we talk about the psychology of trading and we talk about the trading plan. Let's stick with today's topic. I've got 11 more minutes here. So let me make the most value for both of us for those 11 minutes and give you a little feel for some of the other currencies in case you're just wondering from a fundamental point of view what's cooking. Now, Australia and New Zealand, you hear the term commodity currencies. Most people don't know it, but only 5% of Australia's economy is related to exporting commodities. 95% of their economy. 70% of it is just based on retail sales. They're people buying and selling stuff, buying stuff from companies on an ongoing basis. The market tends to dramatize the importance of the gold, of the gold that Australia produces, or the metals and stuff. But that's only a very small part of their economy, actually. How do I know this? Well, I looked it up on Wikipedia, a free encyclopedia of sorts, and just read about it. You could do the same. Just look under their economy, and it just tells you these details. But if you look at the charts, because Australia and New Zealand are very close to each other, and they're both considered commodity currencies, the currency market in its infinite wisdom. Now, again, we're looking at 6 years here. For the last 6 years, you can't tell the difference which one it is. This is Aussie dollar, that's New Zealand dollar. Their charts for the last 6 years are pretty much identical. And just like with the DAX and the Dow, we could take the Aussie and New Zealand charts for the last 10 days, like we did, and they would look identical pretty much. Not every day, every tick, but they're very close. So you start to realize that there's more to this game than just it's a chart. It doesn't matter what it is. Well, it does matter what it is, and there's lots of things you can do to improve your results by going through the trouble of knowing what it is you're trading. Each one of these currency pairs, Aussie dollar, New Zealand dollar, Euro dollar, pound dollar, they all have their own personalities, and they're driven by certain things. So, for example, right now, the Australians have the highest interest rates of the developed countries at 4.5%, and the New Zealand's 2.5%. Now you're probably thinking, a couple of you, our skeptics are probably thinking, wait a minute, didn't Greece have 2%? Didn't this one have 12? Those would be for those. That's nothing to do with currencies, because if you're going to deal with Greece, or if you're going to get involved in exchange rates, you're going to deal through the euro. So you would get the euro interest rate. You would not get the rate for Greece or one of the others. So Australia does have the highest, but for the right reasons, because Australia is doing very well as a country. They're doing very well in all respects. So if you read up on it in Wikipedia, you'll see that they say Australia may have been one of the only countries not to suffer from the 2007-2008 global economic collapse. You know, it was even questionable whether Australia went into a recession at all. So they've been doing so well that they need to keep their interest rates a little higher here at 4.5%, because they want to keep their economy growing at a sustainable pace. So what happens is if your interest rates are too low and you're a solid country like Australia, then you start to grow too fast, so you start running into an inflation problem, which is something more advanced. I don't want to really go there today. So you got the highest interest rates, these two commodity currencies, and they like metals mostly, and metals and coal and iron ore, things like that. And then over in New Zealand, milk. They're the biggest milk producing country in the world. Those are cows, by the way. And also other agricultural products. That's their main business. So they're a different kind of commodity. These are called soft commodities. These are called hard commodities. If you dig it out of the ground, it's a hard commodity. If you kind of grow it either directly or indirectly, then it's considered a soft commodity. But you see their charts are totally identical. They shouldn't be, but that's the way the market, if you got to realize that the Forex, if you took the IQ of the Forex, it's not genius level, there's a lot of shortcuts, but you got to go with what actually is, Talking to my son, he's like, well, when you look at the news, you could think about this or this or this. I said, or you could just think about how it's going to impact the traders right now, because you're putting your stop at 50 points away, so who really gives a shit what's going to happen 3 weeks from now or 6 months from now? We need to figure out right this minute how traders are going to react, because that's all that matters, because you're not going to have your trade. You're probably going to close your trade the end of today, so why do you really care? And he's starting to get it. Hopefully you will too. Now, Canada is also called a commodity currency. Their main commodity is oil. And the U.S. and Canada are major trading partners. So the dollar-Canada pair is influenced. What's good for Canada is good for the U.S. What's good for the U.S. is good for Canada. So the dollar-Canada exchange rate has a special properties to it. Many times it trades like a commodity currency. Many times it trades as an inverse dollar currency, and many times it trades just as a Canada currency. So this is one you want to totally leave alone until you get more expertise. What's going on with the UK right now is the pound is considered to be sick, and everybody's predicting it's going to do really lousy. And the issue is right now, this Thursday, to be specific, in 3 days, there's a chance that the UK may be printing more money, just outright printing money to try to help its economy. This is Mervyn King. He's the equivalent of Ben Bernanke here in the U.S. If you don't know who Ben Bernanke is, you got a long way to go with your fundamentals. He runs the U.S. Federal Reserve. He's a big guy. And over in UK, the guy who runs your money, his name is Mervyn King, and that's a picture of him standing there. And the big problem you guys have right now in the UK is you may be printing more money, so the market's thinking very negatively. At the same time, if stocks go up, then the dollar goes down, so the pound-dollar pair goes up. So the pound has been fluctuating back and forth around these two issues. The pound-dollar pair, I should say. When I say the pound, I was a British pound US dollar trader and British pound German mark. These days, British pound euro trader in the banks for most of my 20 years. I traded the pound-dollar pair, so it's kind of, I call it the pound, but I mean the pound-dollar pair. Now, the Swiss franc was getting ridiculously strong in the end of 2009 and all of 2010 into 2011. And just a matter of weeks ago, the Swiss National Bank, the equivalent of the Bank of England or the Federal Reserve here in the U.S., decided to do something about it. But up until that point, what the world was doing was they were selling the euros. They wanted to invest in Europe, so instead of holding on to the euro, they'd rather hold on to the Swiss franc. So the Swiss franc was getting stronger and stronger and stronger versus the euro, up until a few weeks ago when the Swiss National Bank did something called intervention, where they went out and they actually sold a lot of Swiss francs in an effort to make it a little weaker. But that's some more, you can read about that also on Wikipedia. Intervention, INTERVENTION. Now the Japanese yen, now when I started the business, it was 300 yen to the dollar. Now there's 75 yen to the dollar. So the yen has been a story of a currency that throughout most of the last 40 years has gotten stronger and stronger and stronger. And there was a time where it was rather weak from 2001 to 2007, and this was a period known as the carry trade period. This was a time where the market was really hooked on earning interest. So a good trick would be the Japanese interest rates were 0, and all the other countries were 5 or 6 or 7%. So what traders would do is they would buy these other currencies and earn the interest, and they would sell the yen and not have to pay any interest. Hence, by carrying the trade, they would net be earning the interest. That was called a carry trade. Very popular with the retail trader. They got in on it just before it totally crashed during the 2007-2008 debacle. You can read about that. Again, Wikipedia, carry trade, if you're interested. Recently, the Bank of Japan tried to do what the Swiss did and tried to weaken their currency a little bit. The reason these countries are interested in weakening their currencies a little bit is because it's very hard for these countries to export things if their currency is really strong, because that means the countries that want to buy stuff from, say, Switzerland or Japan, the prices appear very high, because when they exchange their money into the very strong yen or the very strong Swiss franc, they don't get that much of the local currency. So when they go to buy the goods from that country, the prices seem very high in terms of their own currency. So that's the story there. Almost done. These are the interest rates right now around the world. This is courtesy of GFT Forex, because I just cut and pasted it. I don't want to get in any trouble. But these two we looked at. The euro, believe it or not, is one of the highest ones. And down the line, they get lower and lower and lower. These are official government rates. Now, your economic fundamentals, I'm just going to go over this real quickly. Believe it or not, I just got a few pictures to show you. I'm only going to spend another 5 minutes of your time here. The important ones, these are the important ones. The employment is important. Now, why is important? It's just like in your own life. If you're getting promotions or you're getting downsized, it's going to, this is negative and this is positive. So for most countries, when you look at the employment as one number, which is what most countries report, if that number is good, it's a good thing for the currency. If it's bad, it's bad for the currency. And the only exception being the U.S., and that's because of that special relationship it has with the stock markets. I wouldn't waste a lot of time thinking why that's wrong or why that's so. What you want to do is spend your time thinking about how you can turn that into profit. Next would be retail sales. Now you see these things move together. Guess which one is going to occur. Would it be if a country's losing a lot of jobs, do you think its retail sales would be really good or really bad? Duh, they'd be really bad. So these employment, retail sales, they tend to flow together. Most countries, about 70% of their whole economy has to do with the people in that country buying stuff at the retail level. So usually when a country's payrolls are bad, its employment is bad, so are its retail sales. And when they're good, then the retail sales are good. The next step would be something called the gross domestic product, the GDP. Just taking the whole country's economy as one number, all the different things, industrial production, trade balances, everything about a country, and reducing it to one number, which comes out every 3 months for most countries. Now, if the employment's really good and they're selling a lot, how do you think this number is going to be, good or bad? You guessed it, it's going to be good. If these numbers are bad, then this number will tend to be bad as well. So these numbers tend to flow together. Now, the last thing is the interest rates in a currency. That's always an interesting thing. But more important is, what is the government saying about the country? So when a country's doing really good, well, the government's probably saying good things. When a country's doing really bad, the government's probably saying bad things. And usually when a country's doing very good, their interest rates tend to tick a little higher. The exception, of course, being the situation that's happening with the euro right now. That is a one-off situation, but normally within the 2 to 4 or 5% range, a country that's doing good will have the higher interest rates. A country doing bad will have the lower interest rates. That's usually the way it is. And if a country's doing bad and they're giving you only a small amount of interest, you can see there's no reason for people to want that currency. If the country's doing bad, real estate's probably doing bad, and probably opening businesses in that country is no good, and they're not paying much interest. So there's absolutely no reason for money to flow, for capital to flow into a country that's doing bad, so the currency tends to weaken. And when a currency's doing well, it's just the opposite. They want to invest in the real estate, invest in the businesses, and they're getting a good interest rate. So from all the different investment angles, money's coming in from all over the world, and currency tends to go up under those conditions. If you want to learn more about this, you can visit any of the central bank websites. You go to Google, you put the word central bank, and choose your country. So you put Australia Central Bank, Euro Central Bank, UK Central Bank, US Central Bank. And what you'll find when you go to one of these websites is there'll be information on the interest rates going back for 50 years, the interest on the exchange rates going back, say, 50 years, and how much inflation they have going back for, say, 50 years. You know, there's a ton of information. What you really want to look at is, what are they saying right now? Every month they talk about their interest rates and their economy and their inflation every single month or every 6 weeks, depending on the country. It would probably be more beneficial, being a trader and not an investor, to look what they said last week, or, for example, this Thursday, your UK central bank, the Bank of England will make a statement. So you may want to read what they had to say. And the minutes of their last meeting, which took place a month ago, last week, they were posted to the central bank website. You get a pretty good idea of what the people who run the money and run the government and run the currency are saying about it. And you get this information every month or every 6 weeks. To spend a couple hours out of your trading month, do a little soul searching, guys. You guys spend hours and hours and hours staring at charts, and you don't even know what the hell you're looking at. So to spend, 20 minutes here and there, once a week, trying to get an idea of what's really going on, what the real situation is, so you can see the bigger picture and make smarter little picture choices, would be a good idea. All right, so I am done. I thought maybe I'd finish early, but that would be a first for me. That never seems to happen. And let's just let's see where we're at here. Okay, so let me. What I'm trying to do now is to. Oh, there it is. It's over there. I want to stop sharing, and I'm going to session, stop recording. Okay.